Don't do bonds. Do this instead. Now, you know how I feel about bonds, all right? Not a fan. Do bonds serve a purpose? Sure. What purpose do they serve? Well, certainly not to get much yield anymore, because you get a better yield with CDs with no downside risk at all. Have bonds served a purpose in the past? Sure. Absolutely they have. They did well in the 1980s and 1990s. Those days are long gone, my friends. They're not coming back anytime soon. In fact, I just read the 30-year Treasury Bond dropped below 3%. So don't expect anything like you saw in the past for bonds. But what if you wanted something safer than stocks with a higher yield? What could be an alternative to that? This is why I just love you guys on the channel, because a guy asked me about preferred stocks. And man, I have never talked about preferred stocks. I have almost 1,000 videos, and not one time did I talk about preferred stocks. So I'm going to talk about that as an alternative to bonds. I'll tell you the benefits, the negatives, my own history with preferred stocks, and everything you need to know. So smash, subscribe, share the video, and say your comments down below. Do you have any history of preferred stocks? I'd like to hear it. All right, so we're going to do two things. There's not that many preferred stock ETFs, exchange traded funds. There's just not that many. There's like, I don't know, 6 or 7 or something like that. And I'm going to use the biggest one that's out there, PFF. That's Papa Foxtrot Foxtrot. We're going to use that as our preferred stock or a benchmark. And then we're going to compare that to the Vanguard Intermediate Investment Grade Bond Fund, which is predominantly corporate bonds. They do have some government bonds in there as well, but it's a good mix. Now, look, preferred stocks and bonds, they're the same, but they're different. So let's get into the similarities. They both issue a fixed coupon. All right, so a preferred stock has a certain fixed coupon that it pays. You know, let's say 6%. So let's say you get a $100,000 preferred stock. It issues. It will give you $6,000 a year. And a lot of times they're perpetuity, all right? So a lot of preferred stocks there's no mature date on them. Some preferred stocks have a call date, some preferred stocks don't. It's lots of different things going on in preferred stocks. But at the end of the day, you know, as long as that company pays a dividend, you are going to get paid. You ever wonder why there's these GE, for instance, they cut back their dividends like 1 penny? That way they have to still pay the preferred stockholders. Preferred stocks get paid before common dividend holders do. So we know for a fact, as long as the company pays its dividend, even if it's 1 penny, you as a preferred stock owner will get paid. That's how it works. If they cut their dividend outright, that's a problem. We're going to talk about that. All right, so preferred stock has a fixed coupon. A bond has a fixed coupon as well. Bonds typically have a mature date, 10, 20, 30 years or something like that. Preferred stocks don't really so much, some do, but that's the same principle, is you will get a fixed rate of return on that money. And that's as long as the company stays solvent, you will get that. Now, preferred stocks, if the company stops paying dividends, you won't get that anymore. So just keep that in mind. If the company stops paying dividends, you will not get that preferred stock dividend anymore. But secondly, preferred stocks fall under, in terms of liquidation, who gets paid first. The bondholders, in theory, do. We've seen many examples of this not happening the way it's supposed to work, which is completely in violation of all the principles of economics we have in the United States. But be that as it may, stocks fall below the order of preference in terms of liquidation of a company. So preferred stocks even have more risk to them in terms of a company going bankrupt. It goes bonds, preferred stocks, common stockholders, preferred stockholders, and bondholders. So bonds are less risky in terms of bankruptcy. Does that make sense? All right. So those two things right there happen. The similarities are not. So bonds are less risky in terms of the liquidation, who gets paid. Preferred stocks, they're not paying a bond, they're paying a coupon similar to a bond. Now, here's where some of the benefits pay off for preferred stocks. Most preferred stocks are qualified dividends, i.e. you get paid a 15% tax rate if you're in the, let's see, above the 12% bracket, or 0% if you're in the 10 to 12% bracket. Interest on bonds is 100% taxable as ordinary income. So one of the big benefits of preferred stocks is the tax treatment. Very, very favorable. Absolutely. So preferred stocks, you get 0, 15, 20%, depending on your tax bracket. Bonds are whatever your ordinary income is, 10, 12, 22, 24, you name it. So that's a big difference there between preferred stocks and bonds. Much, much more favorable for the tax treatment. Second big difference is preferred stock's going to pay more. Now, look, every single issue is different, but just generally speaking, your preferred stock will pay more simply because there's two reasons for that. One is more risky. Company goes bankrupt, stockholder has less authority and rights to the liquidation amount than bondholders. Number two is that they could cut the dividend even without going bankrupt. I mean, so GE cuts a dividend of 1 penny, preferred shareholders still get paid, but at the end of the day, if they were to say we can't do this at all, the bondholders still get paid, the preferred stocks do not, if that makes sense. So just keep that in mind. 2 cents of riskiness preferred stocks relative to bonds. Now, with that said, you will see, and I'll show you here right quick, there is also a difference in the way they trade on a daily basis. Preferred stocks are still considered a stock, and so a lot more volatile, whereas bonds are not. So, let me give you my experience with preferred stocks. When I was a broker back in 2005 and 6, I've always been a fan of preferred stocks. I got killed in them because I was buying all kinds of financial preferred stocks from old Josh's portfolio, Wells Fargo, Wachovia Bank, Bank of America. So you could get a preferred at Bank of America paying 6.5, I think. Off the top of my head, I can't remember. And a stock at Bank of America with a dividend yield is only paying 4. Something like that. So I'm like, man, I could get more on a preferred stock yield, significantly more, over 50% more than the stock itself with a dividend. You're not really going to get much in terms of appreciation of preferreds, but FYI. They're not. I'll show you something here. You're not really going to get much in terms of appreciation. Not that you can count on. Because remember, dividends, what happens is you reinvest your dividends, you're building the number of shares you have in that stock. And the share price, while it's growing, the number of shares that you have grows as well. And on top of that, the number of dividends you receive grows. So it's really a way to get compounding interest on stocks, common shares for a dividend, just typical dividend. But preferred is not like that. It's more like a bond. You're getting 6,000 here, 6,000 here, 6,000 here. The price per share will move around, certainly more than a bonds, but it's not really doing much because it's pretty fixed. And what I mean by that, you're not really getting it added to buying more preferreds. It doesn't work like that. It works like a coupon on a bond where you just get the cash. So you can reinvest it in other things, that's fine. But it's different than how a common stock works. You're just getting a higher yield than the dividends on a common stock because you're getting less upside in terms of appreciation potential. I hope that makes sense. So you got bonds, preferred stocks. Bonds are least aggressive, preferred stocks are next, stocks are most aggressive. Stocks are most aggressive because they give you the highest potential return because you're building compounding. Preferreds don't do like that. They give you a higher yield because they're more risky than bonds, but what they do is they give you just like a coupon on a bond. You get $6,000 a year, $6,000 a year, $6,000 a year. You don't reinvest it into the preferred stock, you reinvest it to other things. That's the way a coupon on a bond works as well. I hope that makes sense. So bonds, preferreds, stocks. Preferreds are right in the middle. In fact, if you look historically, they've returned almost identically right in the middle. They've done better than bonds, worse than common stocks, for sure, in any given period of time. Now, what happened to me is I was buying all these financials, and lo and behold, I was getting a high-fat dividend. Preferred stock is a dividend, qualified dividend, and I was loving it. And then the financial crisis hit, and kaboom, banks got regulated no end. It was just a nightmare. The price on preferred stocks fell off a cliff. They fell off a cliff. This is on financials. I got no idea what they did on non-financials. My presumption is they probably got killed as well, and I'll show you here in just a second. But the financial markets, which dominate the preferred stock category, banks essentially, Goldman Sachs, got killed. They didn't go bankrupt. The Lehman Brothers did, but other ones did not. And I can't remember if they stopped paying dividends. Maybe Lehman Brothers went bankrupt. Bear Stearns did not. But anyway, I can't remember if they stopped paying I just can't remember. But I mean, at the end of the day, as long as they're paying 1 penny for their dividend, they're still making their payments to the preferred shareholders. And frankly, I just don't remember. I can't remember what happened. But I do know if you looked up the price per your preferred stock, you're getting hammered just like stock market as a whole. It was bad. It was carnage. No other way around that. Which made me say, ugh, and that's why I had forgotten to talk about prefers until this guy put it on this thing. On the YouTube comments because they're wonderful. So let's compare a preferred stock, PFF, which is the largest ETF out there, versus the Vanguard Investment Grade Corporate Bond Fund. I don't know if I can say corporate. The Vanguard Investment Grade Intermediate Bond Fund. Right now, PFF is yielding 5.86. So for every $100,000 you have in there, you get $5,860. Pretty good. Vanguard's investment grade, I keep saying corporate, intermediate bond fund is yielding 3.21. Look, I don't want to get too caught up in why am I using an intermediate grade, just because that's a good proxy. Could you use longer term ones? Sure, we could. We could make longer term ones yield a little bit more with more volatility if we wanted to. I don't. I just like using, anytime I'm looking at bonds, I want to use a proxy. In this case, it's certainly a corporate bond, but an intermediate bond, say 7 to 15 year maturity. Just to make it, to kind of, I don't want to say prove a point, but just to make it fair. Because if you're using long-term bonds, you're going to have more volatility, but you're going to have a little bit of a higher yield. If you're using intermediate-term bonds, you're going to have lower volatility with a lower yield. Not much lower, but lower nonetheless. So PFF is yielding 5.86. VFICX is yielding 3.21. So almost double the yield on PFF. Now, let's go back. $100,000 invested in PFF from inception date was worth $173,000 at the end of 2018. Inception date was 2017. Maybe I didn't do. Yeah, just dropped that. We're gonna say inception date. Oops, probably made a big old noise there. Sorry about that. This is actually from 2008. 2008. This came out in March of 2007, and I didn't get the numbers for the whole year, and I frankly didn't feel like looking. 100%, but anyway, because it'd be too much of a pain. So from 2008 until the end of 2018, your $100,000 in PFF gave you $173,000. That's what you made. That included the crazy bear market of 2008. Now, $100,000 in VFICX is worth $163,000 from 2008 through 2018. Does that make sense? So that's 11 calendar years, 2008 to 2018. Not much difference there, right? Just $10,000 difference between 2008 and 2018. But the 10-year, the last 10 years, where we eliminate this bottom one right here, this guy is up 6.01% annually a year. This guy is up 13.75% annually a year. All right, so this one significantly has outperformed. Was it 13.75? Bear with me just a second. I thought it might be a little bit, hold on, let me just double check that real quick. That seems high to me. Hold on just a second, my amigo friends. 10-year, 13.75. Yeah, so I mean, this guy's kicking butt and taking names. No other way around. That's more than twice that. So if you had $100,000 invested, that guy's worth well over $300,000 now. In fact, let's take our trusty calculator. Yeah, I'm looking at Yahoo right there. There it says 13.75. Man, so let's take $100,000 present value. Let's make sure we're just doing it one. Oops. Yeah, okay, good. $100,000, our present value. No, I'm not making any payments. We get 13.75% is our interest for 10 years. Our future value, that's $362,000. $362. This guy's worth 6.01. That's $179,000. I mean, this is doubled in the last 10 years. This is more than doubled this guy right here in terms of performance. Now, there's a big but. From 1107 to 3909. Oh, I'm sorry, it's 10107, excuse me. It's October 07, not 1. Because this all right, October 107 to 3909. This guy, from a price perspective, was only down 12.66%. This guy, from a price perspective, was down 53.82%, which is even worse than the Vanguard Total Stock Market Index, which was down 50%. All right, so now, this doesn't seem that bad. It's kind of like the Wellington Fund, right? It's only down 23.28% in 2008. But when you factor what happened from 2007, which is the beginning of the insanity of it, all the way through March 2009, we're down more than a half. And that's what I was talking about, where I got hammered. It killed me. I mean, my goodness, I could not tell you. It's sickening to open up your investment accounts if you had any preferred stocks and seen it down 53%. Now, they came back roaringly because being down that much, and they were still paying their coupon. That's the issue here. As long as the companies don't go bankrupt and they still pay their dividend, you are going to get your coupon. And so what happens is when they start getting knocked around, people say, oh, there's huge value in these things. They're trading at such a discount to the interest rate I'm getting, the coupon, that even though I got hammered, look at that, 39.27, 13.96, 18.25, 13.45. So even though I got hammered this year, I made it back if I would have held it, and I didn't. I didn't because I'm stupid. I was just like everybody, man. I got out of it because I didn't have hardly any money at that point, my friends. And now, so this guy was down 12.66, and it did okay. I mean, 17.73 and 10.46, 7.71, 519. That's all good. Nothing wrong with that. But doesn't hold a candle to 13.96 to 18.25 to 13.45. I mean, these numbers are just extraordinarily good. And then you look at 2014, 5.8, 13.5. 2015, 4.62, 1.53. 2016, this didn't do as well. 2017, 8.33 to 4.15. And even in 2018, this guy was only down 4.77. So you see, this right here, if you could have stuck in there, you would have done freaking fantastically well, without question. The problem is, could you have? Now, let's go through this real quick. When was the preferred stocks ever did anything near that kind of carnage? The answer is never. And the reason for that is because this was, and I hate to say once in a lifetime because we don't know, but the preferred stocks are predominantly issued by banks, and banks got killed in 2007 and 8. And so because of that, the preferred stocks got killed as well. But as long as you held a company that did not go bankrupt, you got paid. And as long as you didn't sell, you made money, you made bank. Now, will that happen again? Probably not. If the history of preferred stocks are actually quite 4.77, 2.2, that's typical. I mean, for the history of downside of preferred stocks, it's typically a whole lot less volatile that we saw in that once in a generation, once in a lifetime. I don't even know what to call 2008 anymore. But that was a bank crisis run amok. Will that ever happen again? And I got no idea. My presumption is probably not. But who knows? Who knows? But that's why I like preferred stocks. Absolutely. Now, this right here, we know for a fact there's no getting around the current yield of 3.21. I mean, it's just none, my friends. So you're going to get this without question. And the reason you're going to get that is because that's what the current yield is. Bonds don't give you appreciation or depreciation. They give you the current yield because they mature at a certain set time. And when it does mature, you get the par value back. Par value back is $1,000. A lot of prefers don't have a maturity date, so they keep paying 6%, 6%, 6% each and every year. No adjustment for inflation, it's just 6% coupon each and every year. I hope that makes sense. So if interest rates rise, interest rates drop, it doesn't matter. As long as it doesn't go bankrupt, you're getting that 6%. Interest rates rise and interest rates drop here, it doesn't matter. As long as it doesn't go bankrupt, you're getting your $1,000 at par plus a current yield right there. And so that's why I love prefers relative to bonds, because that's not going to get the job done. If you're going to do 3.21, you might as well just be in CDs. Some guy was just posting right now, the Vanguard money market is paying 2.25 or something like that, or 2.45 on the money market. Now, that's not FDIC insured. It could break the bank, but still, you can get CDs easy now, 2.5%, 3%, without locking up your money for a significant amount of time. So if I'm looking at bonds, my alternatives are CDs, cash, and preferred stocks without question. But Josh, preferred stocks aren't like bonds. They're more volatile. We've already established that, my friends. Yes, in 2007 to 2008, horrific volatility. No other way around that. It's worth the risk, in my opinion. Absolutely. Is it worth the risk to you? I don't know. But you are getting right now on PFF 5.86. Not too shabby. Taxable much more favorably than this guy right here. So something to think about. I'm not saying you go buy PFF. I'm not saying that. I'm saying that is my proxy for preferred stocks. Now, I will tell you, you can look at this wonderful website. It's called Preferred Stock. What's this called? No, hold on just a second. Oh, man, I don't think I have it anymore. Right here. This is what it's called. Yeah, preferredstockchannel.com. Maybe I'll do a couple videos on this because, man, they got some wonderful stuff on here. Preferredstockchannel.com. And it talks about the various discounts, ones that are paying opposite discount, whatever it is. I forgot what it's called. We got various discount. They got all kinds of different things in Preferred Stock Channel. Preferred securities and financial, bullish 200 preferred securities getting way oversold. Just all kinds of different. I love it, man. This preferredstockchannel.com is fantastic. A whole list, a whole plethora of different stocks. preferred stocks, and you can look like they'll say they'll give you like a Wells Fargo preferred stock, for instance, and you say, or Goldman Sachs, for instance. Maybe I'll do one just on that alone because I think that's actually pretty interesting to me. Now, just remember, preferred stocks is not compounding. You're not getting compounding interest like you're getting on stocks. You're just getting a straight coupon. But if someone's trying to get a yield and they're saying, man, I don't want to take too much risk like stocks, but I got to get more than this, preferred stocks are probably a good option. All right, that's anyway for us. Smash, share your comments, subscribe, and then let me know what you think, and we'll talk to you next time. Thanks now.